And we are live and we are back. Let's go. I'm Cory, your host. One half of the Cory and Philip That podcast. And I'm back like I never left with another installment. This is the end of the year wrap up episode. This is not technically a money mindset. We're doing the 2024 into 2025 how to win with your money end of the year episode. Or I've been telling y'all I'm gonna drop this holding off. I realized I watched last year's episode and I realized one of the reasons my body was telling me drop this a little bit earlier is because I'm gonna show y'all how to use the tax withholding calculator if you listen towards the end of the episode, and it cuts off like it starts over every year. So if you don't listen to this when I drop this on New Year's Eve, it won't. It will work roughly for you. It'll be adjusted for the new tax year brackets. At least that's what they've done for the last couple of years. But if you listen to this episode as soon as it drops, you'll be able to make use of the calculator, and we'll go over that, like I said, in an episode. All right, but before we get started, y'all, make sure y'all comment, like, share, and subscribe. Shout out to the YouTube algorithm. Make sure you leave those rating reviews on the podcast platforms as well. My information, as well as my co-host Jordan information, can be found in the description on YouTube. All right. We're not going to go over the monthly card payment. We did a student loan episode on the last episode. As far as a recap of the student loans, President Biden administration said they're going to withdraw the student loans. Too much turmoil, change over. The student loans in mass never got forgiven. We tried to tell y'all it was never going to be forgiven. If you've been listening to this podcast since it dropped in, was it 2021, March, April of 2021, I believe it was. Yeah, whenever we had to get the jab, then you would have known we've been telling you to pay off your student loans for over 3 years now, going on 4 years. We recovered student loans in depth on this podcast. Probably need to update the playlist, but there's a whole 4-hour live stream that I did over the student loans just in general. And then when the forgiveness was supposed to happen, when it went all the way to the Supreme Court, we covered that in depth as well. Long story short, highly unlikely your student loan is going to be forgiven in mass. You need to take control of over your life and over your finances and pay off your student loans. And speaking of getting control of your finances, we're going to talk about how you can do that in 2025. But last but not least, this is for entertainment purposes only. Myself, no Jordan, fitness financial professionals. Anything on here is for entertainment purposes only, and you need to seek a professional and do your own research before taking any action. All right. Then also at the end of the episode, we're going to get into the major updates that will be coming to this podcast in 2025. All right. I don't like to waste y'all time in the beginning. That way, y'all can watch what y'all want to watch, and then for those stay to the end, you're gonna have all the updates. All right. But let's get into it, y'all. How are we going to win with money in 2025? Look at me being sloppy. It's early morning episode. I haven't recorded early in the morning. I think I'm going to start doing back to early morning instead of late at night. I think. My wife was like, why are you getting up? I was like, I got to go record. She's like, you don't record this early. I was like, I know. All right, y'all, 2025 tax brackets. For this one, we're going to hop into not only Nerd Wallet because I like how their chart is best. For whatever reason, the IRS still just has, just plain text of the brackets, but I think it's a lot better for it's a lot easier to visualize the brackets with this chart. So we got the 2025 tax brackets. This will be going into next year. So long story short, the taxes you'll be paying are going to be on the 2024 taxes when we have to file by April 15th of 2025. So this is that bracket. We went over this last year for what this year's bracket will be. But going into next year, 2025, this is going to be the new tax bracket. All right. Again, traditionally, I'm just going to do the math here so I can see here. But usually the single tax bracket and the married filing jointly tax bracket, they're usually double of each other up until you get into the 32% tax bracket. It's like, actually, no, 35 this year. Yeah, 35%. Oh, excuse me. All right. But anyways, as you can see here, so single filing status, 0 to $11,925. Long story short, we live in a progressive tax system. So as you make more money, your money gets taxed at this particular rate. So the tax filing rates are 10, 12, 22, 24, 32, 35, 37. Again, these are marginal tax rates. This is not your actual tax rate. If you want to know your actual tax rate, you have to look at your effective tax rate, which is in short taking how much money you made, how much you paid in total in taxes by looking at how much you're going to pay in these various tax brackets and then dividing that by how much money you're actually getting taxed on. I believe it's either taxed on or your gross. One of the two. Let me see. It's not. My Google is not working for me. Yeah, it's by your taxable income. So long story short, let's say your taxable income, let's say for whatever reason, for simple math, you itemize and you have $50,000 in deductions, right? And you make $150,000 a year. So you're going to get taxed on $100,000. Let's say in total in taxes, you paid $15,000. So 15,000 divided by 100,000 is going to be 15%. So your effective tax rate was 15%. And let's say you were single, right? I'm just throwing out numbers here. But if you were single, you're going to fall into the 22% because this is what you're being taxed on. So you really would think, oh, I'm in the 24% tax bracket. No, after your deductions come into play, that's actually what you get taxed on and where you actually fall into your tax bracket. For those of you who have side businesses, side hustles, like myself, and you're not, paying taxes throughout the year, long story short, if you like come into like a lump sum of money that has to be taxed for whatever reason, that gets taxed at your full tax rate. So that full tax rate is the percentage where you fall at. So let's say they got $50,000 in deductions, but then they had like some lump sum on New Year's Eve for 25,000. That would put them back into the 24% tax bracket, and they're going to pay the full tax rate of 24% on that $25,000. All right, so a little around $6,000. So under that, around there, around $6,000, you're going to pay your full tax rate on that, because the way it works is they adjust your tax rate when you do your W-4, and when you do your if you pay state taxes, they're going to ask you how much money do you plan on making for this whole year. You tell them you plan on making $150,000, and then so they're going to adjust your taxes so that throughout the year you're going to pay how much they believe they think you're going to owe based off of what you told them, right? I mean, taxes can get complicated, but when it comes to something that has not been taxed, or if you do like 1099, anything like that, you pay the full tax rate if you already have some income, because you have not paid any taxes at all on that money. And so it hasn't been adjusted for that prorated rate that you're going to pay throughout the year. And on top of that, it gets added to the end of your money. So you had 100,000, then you add another 125,000. So if you add, 125,000 here, you're going to land here in that 24% tax bracket. All right. All the tax professionals out there, this is not, I'm not a financial advisor. It's not financial information, but I'm pretty sure that's close to right, if not exactly right. All the tax people out there, you can yell at me and say where I was wrong. All right. But again, we're all going to pay this single, married, whichever one you file into, married filing separately, had a household. Again, for those who don't know, married filing separately and single, they have identical tax brackets. A lot of times you won't see married filing separately. You'll just see single because they are the exact same. For head of household, again, for those who don't know, head of household is for really beneficial when you make essentially less than, I don't know, $100,000, because once you get over $100,000, you're going to get back tax at the single tax rate. All right. So for those of you who are head of household and you're making more money, but you're not feeling that tax benefit, that's because, as I said, as you make more money, as it gets added to the end of your income, you're going to pay that. So yeah, once you get over $103,000 for next year, in short, say you get a raise, you feel like, man, I don't feel like I'm making more money. It's like, yeah, because you're getting taxed at the single rate, which is the highest rate. All right. Now, 0 to 17,000, 10%, 17,000 to 64,000, 12%, and then 22% is going to be 64,000, 103,000. That's where you're going to see that benefit. But, you're single parent, whatever it is, you file a household and you're making well over $100,000, if not, $200,000 plus, you're not going to see any tax benefit or taxing you at the single tax rate. Okay. So that's something that everyone needs to be mindful of, that out there filing head of household. But here, when we're looking at this single tax bracket, at 0 to 11,000, almost 12,000, or at 0 to almost 24,000, you're going to pay 10% on this money made. So let's say it's 12,000 for simple math. 10% of 12,000 is $102, $1,200, $1,200. So that's how much you're going to pay in taxes at the federal level. State taxes, there are too many states for me to go over them. But you're going to pay whatever you're going to pay at your state level. This is you're going to pay at the federal level. So everyone who files single and you make $12,000 or more, that is taxable income, you're going to pay $1,200 at least. All right. And then for married couples, it's going to be $24,000, and obviously adjusted for $1,700 for head of household. And then it just continues to go through that. So when you get to the next tax bracket, it's about $12,000 to about $50,000. That's $38,000. $12,000 to $50,000 is $38,000. On the next $38,000 until that you make over $12,000, you're going to pay 12% tax on that. 12 times 38. I don't know. 10 times 38 is 3,800. So it's probably around 4,000 or so dollars that you're going to pay in taxes. All right, now here, the nerd in me wants to know what it is. $4,500. All right, so $4,500 is you're roughly going to pay in this next bracket. So we're at $1,200 for single. Now we're at $4,500. So now we're at $5,700 that you're going to pay in taxes. All right, once you get through these first two brackets, and then you're just going to continue add it up. And then for married people, it's going to be $2,400 on your first $24,000 roughly, and then 24 to 96 was at 72. So it's going to be another 12% again. I don't know what that is. $8,600. So plus 24. So a little over $11,000 is what you're going to end up paying. And again, a lot of people, married couples, if you know, dual income households, should I say, that are for married couples, you're likely going to be, a lot of married couples, just based off of what the numbers are for income, they're going to fall into this tax range of 23 to 94 thousand range, that 12% range. That's where a lot of people actually end up falling into, just based on what the numbers say people's incomes are for married couples. If you're two 6-figure income households, you're going to be somewhere likely in this 22 to 24% tax bracket, depending on how much you have in deductions. All right, that's usually going to fall out. But again, that's not your effective tax rate. So once you want to find your effective tax rate, you're going to add up everything you pay in taxes, even state taxes, and then divide that by how much you're actually getting taxed on. All right, so again, just go over them real quick for single people, 0 to 11,600, then 11,600 to 47,150, 47,151 to 100,000, 100,000, 191, 191 to 243, 243 to 609, and then everything over $609,351 if you're single is going to be taxed at the 37% tax rate. All right, again, for married couples, the benefit of being married, one thing I say all the time is don't get married if you don't want to be married, and don't marry the wrong person. However, one of the financial strains that people deal with is that they do kind of everything but get married, have kids, live together, all that different type of stuff. And so you're paying literally, most people, at the federal rate, because most people aren't making, they're not making over $487,000 or $243,000, however you want to look at it. You're paying double the taxes, and you don't get the benefit of being married, right? You got 2 healthcare plans, yada, 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 all the different type of stuff. And so you just see here, essentially from the 10% tax bracket all the way down to the 32% tax bracket, it is literally double. Make sure. Yep, it's double the amount of what the single one is. So for single people, the first tax bracket, 10%, is $0 to $23,000. Then it's going to be $23,000 to $94,000. Again, married people, from $23,000 to $94,000. That's over $70,000 that's only being taxed at 12%. Versus if you're married, if you're single, if you're making over $70,000, you're going to be starting getting taxed at the 22% rate. All right, 12 to 22%, that's 10% spread right on taxes right there. Not exactly how it works, it's percentages, but in short, from 12 to 22%, and that's the biggest jump, by the way, in the entire tax bracket, from 12 to 22. All right. Then you got 94,000 to 201,000. Look at that. That 22% tax bracket is huge. Then you got 24% is 201,383,000. This is where you're talking about they being in the middle class. You're getting destroyed here in this 22 and 24% tax bracket. They're just so wide. And as you can imagine, if you're in like this upper range of 22% or 24% or 32%, whatever it is, it's going to be hard to get you knocked down into the next tax bracket, just because the brackets start getting over $100,000 within their range alone. And I mean, look, if you got $100,000 in deductions, that's good. But, from a W-2 standpoint, I mean, hopefully those things actually benefit you long-term in your financial planning. And you're not just taking a deduction to take a deduction and pay less taxes. The 24% tax bracket for married filing joint, 201,000 to 383,000. Then it's 383,000 to 487,000, and then it's 487,000 to $731,000. All right, I'm leaving off the extra couple $100 that they put on here. So that's what it's going to be for married filing jointly. Again, like I said, married filing separately, that's the same as single. 1.2 for people who, unfortunately, or maybe fortunately, however you view it for your life. But if you're getting divorced today, New Year's Eve, December 31st, 2024, and you end up getting divorced today, a lot of people end up divorce for the end of the year because they want to make it final. But you have been paying the married filing joint tax rate all year, and you end up getting divorced today. They're going to ask you when you file your taxes, were you married or not? On December 31st, 2024, you're going to say you were not married. And so they're going to calculate you needing to be at the single rate. Okay, let's listen when I say this. If you were married, you cannot select the single option. But for people who are getting divorced, or if they have other, you know, extraneous financial situation, they might want to file married filing separate. Sometimes it's beneficial. Somebody has a lot of medical costs, things like that. But for most married people, it's traditionally beneficial for you to file married filing joint. But if you're in a situation where, let's say, you are getting divorced, or you're going to get divorced this year, or you might, you need to update your W-4 and, like I said, your Maryland state tax form, or wherever state you live in. If you pay state taxes, you need to update tax form. Oh God, hold on, y'all. Ooh, sorry about that, y'all. You need to update your state tax form as well to say that you are going to be married filing separately, so your taxes get updated. Because when you file in 2025, your 2024 taxes, they're going to say, hey, you were not married, which means divorce, however you want to call it, but you're not married, meaning you need to pay single, married filing separately. Had a household tax bracket, but for most people, it's probably going to be in single. They have this married filing separately tax bracket, though, for people who end up being divorced in that year, so you don't get hammered in your taxes. Again, long story short, for most people, you're paying half the amount in taxes when you're married filing jointly versus married filing separately. But if you end up getting divorced in that year let's say you end up getting divorced and you just forget to update your W-4, because they double check that your taxes are properly, updated as far as your filing status when you file, right? I mean, this is your filing status, so literally here, right? For each filing status, so you really don't get this checked out until you file your taxes the following year. You're going to get hammered on your taxes. So that's all, unfortunately. But all my clients who are in a situation, or people who do have household situation where they flip with their they co-parent, right? And they flip on who gets to claim the child. You got to remember, make sure you update your head of household tax filing status back to the single status, every other year, until the child turns 18, and whenever they're no longer dependent and you guys are claiming them. These are things that you need to be aware of, because you will get hammered when you go and file your taxes. The government/IRS does not care that you end up getting divorced and you forgot to file. They're going to come and get their money. Now, obviously, you can set up tax payment options, payment plan, but these are things that you need to be mindful of going into next year and forever when it comes to your tax filing status. All right. Again, for head of household, this is 2024. For 2025, we got 0 to 17,000 for head of household, 10%, 12% tax bracket is going to be 17,000 to 64,000. 22% is going to be 64,000, 103,000, and then 24% is going to be the same as what I did for single. So 103 to 197, et cetera, all the way down to the 37% tax bracket. All right. So again, once essentially you make over $103,000 in 2025, you're going to be taxed at the single tax rate if you're married, if you're at a household. So that's something just to always have in the back of your mind if you're wondering, like, dang, why are my taxes so high? All right. So now let's get back into the actual IRS website. I like to have, so you guys can see that I'm getting it from the source. People are like, oh, niggas be lying on the internet. It's like, oh my goodness, shut up. All right, anyways, tax adjustments. Again, standard deduction, by the way. So again, long story short here. So for it says right here, single taxpayers, what it's letting you know is that this is your standard deductions for anybody. And it's going to be $15,000. So long story short, if you take the standard deduction, which most people are taking now, whether you're single, married filing separately, married filing joint, head of household, that gets deducted, subtracted from what you're going to pay taxes on. So let's just say, long story short, you're single, you make $100,000, and you're going to take the standard deduction. You're only going to pay taxes on at most $85,000 of those dollars, because you are taking the standard deduction. You do not pay taxes on your deductions. All right, difference real quick between deduction and a credit. A credit, in short, is money they're going to credit you, right? Like give you back. Like when you get money deposited into your account, like your paycheck, that is a credit. When money gets taken out of your account, that's a debit. I know credit can get confusing here because like what's a credit card? Bad terminology, I guess, when they make these things up. But a credit means if you get a $2,000 tax credit, you're going to get $2,000 towards your balance of whether you're going to owe or get a refund, in short. So credit, you can sort of view it as money that you may get refunded or at least decrease how much money you're going to owe. So you file your taxes, you're like, oh, sweet, I'm not going to owe no money this year. Any money this year? No money. I'm not going to owe any money this year. Then as you get towards the end of your taxes, you're like, oh, I qualify for a $2,000 tax credit. You're going to get $2,000 in a refund. Long story short, that's oversimplified. That's just the general way to look at it. So for a deduction here, this is money that you're not going to pay taxes on. For married couples, it's going to be 30 bands. Jesus. Whew. All right. So to flip back over here. All right. I'm just looking at that, the 30 bands. And then on top of that, since my wife is a disabled veteran, the money she brings in is not taxed at all. So, but man, get out here, y'all, and do what you can to get this money and not pay your taxes. Anyway, so let's just say you're, like I said, you're single here and you make let's say you make $115,000. All right. Take standard deduction, so you're going to drop down to $100,000. So your gross income will put you in the 24% tax bracket at 115. But then taking that standard deduction of $15,000 will put you at 100K, and that's going to put you in the 24% tax bracket. That's the long story short of how it works. Same thing for married couples. You know, you do, let's say you end up making $120,000, right? 30%, 30K tax standard deduction. And then so you're going to be at 90K, so you're going to be in that 12% tax bracket. All right. And for married people, I mean, you're going from 22% all the way down to 12. But again, you're already paying taxes. Again, it's a progressive tax rate. So it's not, when I say you're not like saving money, you know what I mean? Like, again, this is all generally, if you fill out your W-4, your Maryland state tax, your Maryland. I was saying that because I live in Maryland, but you fill out your tax forms correctly, all this is supposed to be handled. It's supposed to. I'm not saying it is. You know, everybody knows how complicated and how stressful taxes can be in dealing with the IRS, but it's supposed to be handled in all these forms you're supposed to fill out. They're supposed to make it so that you can feel more comfortable that you're paying whatever you want to pay. Some people want to get a larger refund. If you want to get a larger refund, in short, that means you're paying more taxes throughout the year. And then if you want to you don't want to owe too much, you can get a penalty for owing too much. Then you're going to be having more money in your check. Little nugget as well. There's no penalty for getting too big of a refund. Don't break the law here, right? No tax fraud here. But if you want to send the government too much money throughout the year, they will gladly refund you that money with no penalty. If you want to loan them that extra money. But you can get penalized if you owe too much money. So if you don't pay enough money throughout the year, not sure exactly. I mean, it's going to be based off your income and various factors, myriad of factors. But long story short, if you want to know whether you should owe or get a refund, it's best to get a refund in the sense of, or pay too much, because you will not at least get penalized for that. Right? If you end up giving them $10,000 extra dollars, you make $50,000 a year, they're gonna refund it back to you. But if you end up owing $10,000, regardless if you have the money or not, that doesn't mean they're not going to penalize you. It has nothing to do with whether or not you can pay it, right? So you want to, not pay $10,000 in taxes, in the sense of you end up owing that, now you might get penalized for that. Even though, I'm gonna have the money sitting on the side. Now you kind of want to avoid that situation. All right, but again, married filing joint, yeah, it's $30,000. Single taxpayers and filing separately is $15,000, and then head household is $22,500. So it's only a couple $100 increase for each of them. $400 for single, $800 for married, and then $600 for at a household. We already went over the tax rates. The alternative minimum tax exemption amounts for 2025. The exemption amount for unmarried individuals, so people who are either filing single, head of household, or you're divorced and you're filing married file separately. Again, you can file married filing separately and still be married. Okay, I'm going to make sure I'm clarifying that. I'm saying you can take advantage of changing your tax filing status to that if you know you're going to end up getting divorced, or we just want to be prepared that you're going to get divorced, because divorce proceedings can unfortunately linger on, and you just want to make sure you don't get hammered in your taxes that following year. And you're likely, if you're in the process of getting a divorce, right? I mean, like, you're actually in the legal process, not just yelling at each other. You need to go ahead and change your tax filing status to married filing separately anyways, because you need to likely file, your taxes separately from here on out. And so it'll cover you there from a tax rate standpoint when you're filing your taxes. So you're not at the married filing joint rate. But if you're married filing separately, it doesn't guarantee that you're going to get this tax exemption, because you can still be married filing separately and legally be married. All right. But this exemption amount for unmarried individuals increases to $88,100 from $68,000. Sorry. Ooh, from wow, almost $20,000 increase, and phases out at $626,000. Wow. For married couples, okay, you still get this from married. So again, I don't know everything about taxes. Married couples, the exemption is $137,000, beginning to phase out at $1.2 million in income. Earned income tax credit. You have to have 3 or more qualifying children. So if you don't have 3 children, it's not for you. The tax year, so this not be for me. My wife and I, we plan on stopping at 2. 2025 tax income credit amount is $8,000, increase from $7,800. Qualified transportation friend benefits. I mean, it is what it is. HSA, and we're gonna get to this at the end as well, but HSA, well, I guess not now that I have this on here, but we're still gonna get into it, is $3,300 if you're single. Wait. Oh, these are cafeteria plans, something else. Okay, something. Yeah, okay, I need to skip over that. There we go. I know I want to get some here. The gift tax limit. Gift tax limit went up another $1,000, again from $18,000 to $19,000. So long story short, the gift tax exemption here, or limit, is if say you gift someone $15,000, the IRS says you don't have to pay taxes on that, and that's total throughout the year, and it's based on an individual basis. So long story short, we've been talking this whole time, like if you're married, if you're single, and your tax brackets and things like that, and how if you're married, filing joint and one person works, the other one doesn't, you can still do something like a spousal IRA, where the person not working can still have an IRA because their taxes state that they make X amount of dollars. And the way it works for IRA contributions is that your taxable income has to be more than the money you contribute. And when you do married filing joint, your taxable income is your other spouse's income, your spouse's income. That works. For the gift exemption here, this is on a one-to-one basis. So in the sense of a married couple does not have a $19,000 2025 gift limit. Just that husband or that wife has that $19,000 limit for one person. So if you have say you got a son-in-law and a daughter, you can gift your daughter-in-law, or whatever I said there scenario, but you can give one of them $19,000, you give the other one $19,000. That's actually $38,000 you can end up giving them, and then your spouse can give them $19,000 each as well, right? So it's on an individual one-to-one basis on how they calculate this, and then again, it's for the whole year. Also, as well, if you go over this amount, it is on you to let the IRS know that you went over that amount. So it's not like something they can just kind of flat out ask you, like, hey, did you give any money? You got to notify them. I can't remember the name of the form off the top of my head, but you got to notify them when you gift this. And again, you're going to get taxed on anything over this dollar amount. So if you do $19,100, you're going to be taxed on the $100. Again, the $19,000 gets excluded. All right. But if you're gifting $19,000, I'm not sure you're too worried about, $100,000 in taxes. Personal exemptions, yeah, still at $0 per year. Itemized deductions, no limitation on 2025. Sorry, I feel like I saw a bug in my face. Okay, cool. That's it for that. Again, long story short, gift tax is going up from $18,000 to $19,000. And the standard deduction for single taxpayers and mail and filing separately is $15,000. For married couples, it's $30,000. And for head of household, it's $22,500. All right. Up next, we're going to get into the 401k. Shout out to the 401k contribution limits going up a little bit from $23,000 to $23,500 in 2025 for employee salary deferrals. Again, remember, this key word here is employee salary deferrals. Okay. keywords. Here is employee salary deferrals. So that's how much money you as an employee can put into the account. This does not include how much money your employer can put in there. All right. And then for employee and your employer is $70,000 contribution, both of you that can put into the account. So long story short, again, if you're maxing out your 401k, right? And let's just say you're putting in $23,500. And let's just say you make, an insane amount. Let's just say you make $300,000 and your employee is going to match you up to 10%. Well, if your employee puts in 10% of how much money you make, 10% of $300,000 is $30,000. Remember, the most you can put in is $23,500. So you'll only obviously be able to put into that account $53,500. Remember, the limit's at $70,000. So for people who have, insanely high incomes, there's that. And again, remember, 401ks are, again, not employer they're employer based, but it's different from, job to job, and if you're married, spouse to spouse. So if you got, two people married, then your limit here is technically, what is that? $47,000, right? Because you got a job, dual income household, and then it's $140,000 for your limit, right? So this is sort of like the gift tax it implies on an individual basis. And since this is from a job standpoint, these are 401ks or employer-based accounts, then if you have multiple jobs, then you get all these limit increases. So if you got two jobs, it's not that your limit in total combined is $23,500, sort of like with an IRA. How IRA has a total limit that you can put into them. Nope, a 401k is based on each individual employer you have. So literally you have a 401k at job A, a 401k at job B, and they each have to deal with these limits. All right, so it's not a total limit between all of your 401ks. Now, if you end up, say you have two jobs, but you have one employer, you're going to have to figure out exactly how that works there. But if you have two separate jobs, two separate companies paying you, then that's how it should be. I don't know how it works like if you work for a subsidiary of one or the other one. So got to get clarity on the HR department and maybe accounting as well. Maybe even a tax professional on exactly how that works. Excuse me. As far as if you're age 50 to 59 or 64 and older, you're eligible for the catch-up contribution limit. That's an additional $7,500. So long story short, and again, that's in total that you can put in. I do not believe that gets adjusted to, well, it does get adjusted to the combined amount for the employee and employer contributions. But if you're 50 and older, you can, and there's, by the way, this one is 50 and older, I believe, by the end of the year, this tax year. So even if you're 49, as long as you're born, as long as your birth year is what, was that 1975? Yep, 1975, right? If you're born in 1975 or before, then you can put another $7,500 into your 401k. So that's going to put you at what, $31,000 that you can put in there. And again, long story short, if you want to know if you're behind, the government has let you know once you turn 50, you can put a catch-up contribution, and catch-up literally implies that you're behind on something, right? So that's what you can do for there for your 401k. Same important note, getting in 2025. Age of 60, 63 will be eligible to contribute up to $11,250 as a catch-up contribution. Wow. I did not read these articles ahead of time. This is new news to me. This means it's not like the financial information I'm looking at is for people at retirement age. Wow, that's great. It's a good thing and a bad thing, right? That's the devil's in the details. So I tell you, if you want to hide information, put it in a book. As I said, if you want to know when you're like truly behind on retirement contributions, it's 50. The government is going to tell you, hey, if we're going to let you put some extra money in here, even if you're not quote unquote behind, it just wants you at 50, then you can put in this catch-up contribution. But as everyone's been complaining about Social Security, how much it costs to retire, yada, yada, yada. Now they've changed it to beginning in 2025. But if you're between the ages of 60 and 63, you'll be eligible to contribute up to $11,250 as a catch-up contribution. So a little under $4,000 extra. This means those 50 to 59 or 64 or older will be able to contribute up to $31,000 in 2025. Yeah, okay, $31,000 in 2025, and those 60 to 63 will be able to contribute up to $34,750 in 2025. Wow, Depending on your plan, you may be able to make post-tax contributions beyond the pre-tax and Roth contribution limit, but less than combined employee and employer contribution limit to invest. They're just saying, the rules around contributing this. Obviously, reach out to your 401k and 401k provider, whoever holds it, whether it's Fidelity, Vanguard, or whoever at your employer. Speak with HR, things like that. If you're going to be putting in this much money, you probably need to be speaking with a tax professional as well. So you're just understanding exactly what putting in this amount of money, how it can impact your taxes. All right, for Roth 401k contributions, there's the exact same as a traditional 401k, so nothing changes on the numbers. For those who don't know, long story short, the main difference between a traditional 401k or a 401k. So if you don't hear the word you don't hear the word Roth, assume it's traditional. So a traditional 401k, because you can see here it says 401k contribution limits, right? It should say traditional 401k here or traditional IRA versus a Roth IRA. But when you see the word Roth, that essentially means that the money that you put in is post-tax. So let's say you make $1,000 and you're making let's say you're getting paid $1,000, but like, hey, I want to make $100 contribution into my Roth 401k, then you're going to get paid $900 because that money comes out of your check post-tax. And since it comes out of your check post-tax, when you withdraw the money out of the account, once you meet the withdrawal age limits, which I think is 59 and a half or whatever it is, then you do not have to pay taxes on that money because it's already taxed. For a traditional 401k, that money is pre-tax. And so let's say you're making $1,000 in the same scenario, and you say you want to put $100 into your traditional 401k, you're not going to end up getting paid $900 like in the Roth scenario because this money is pre-tax. And so this money is going to come out like your medical deductions due for your healthcare, your dental, your vision, any HSA contributions, things like that. And you're not going to pay any taxes on that money right now, but you will pay taxes on it when you withdraw the money. Other note as well, for traditional IRAs, that money is pre-tax as well, but it's more of a deduction because you're still gonna have to pay Social Security on that money. When you have money taken out of your paycheck, you do not pay any taxes on it at all. It's the same thing with an HSA. An HSA through your employer, you're not gonna pay any taxes on those contributions, but just like a traditional IRA, if you have an HSA through, like a marketplace and you're putting money in post-tax, like out of your check, but when you file, like you can with a traditional IRA, and you're saying, hey, government, I put $1,000 to my HSA. I want this tax deduction. You still got to pay Social Security on it. So that's one little nugget as well. If you have HSA through your employer, or if you're doing a traditional 401k through your employer, you're not going to pay any taxes on that money at all. But when you take a tax deduction, you still have to deal with paying that Social Security on there. All right, like a Social Security, whatever the hell it is. If you have access again to a 401k, and a Roth 401k, it's across both. So that is the one thing that it is tied to. Your total 401k limit, regardless of type of contribution that you do, is at per employer is, the $23,500. That's what it's telling you as well. You don't have the ability to do $23,500 in your Roth 401k and $23,500 in your traditional 401k at the same employer. It's the total amount in a 401k at a single employer. For this contribution that they're showing you right here. If you're under 50, obviously, then it goes up for the catch-up amounts. All right. And also, to your employer's contribution, everyone has a traditional 401k. They've been talking about changing this, but everyone, if you're taking a match from your employer, you all have a traditional 401k, even if you do a Roth 401k contribution for your money, because your employer contribution is always pre-tax. So long story short, depending on how, it's set up, but it's likely you're just going to see one big old balance that you have, 10,000, 20, 30, 50, 100, 50, 200, 500, whatever you got in your 401k. But if you actually decide to withdraw or roll over that money, say you change employers, you want to roll it over to your rollover IRA at Fidelity, no sponsorship here, but you want to roll it over to another brokerage, then you're actually going to see how much money you have that is pre-tax or a traditional 401k, and how much money you have in your Roth 401k. So if you do a Roth 401k, that means your contributions or the employees' contributions are post-tax. Any contributions that your employer makes are always going to be pre-tax. All right. And I think they're changing that law. Then, I will update you when that law gets changed, if it ever gets changed. 401k. Okay, they're just going over again here. Look at this change. It used to be $75,000. $7,500 for the catch-up contribution. They just had a flat contribution once you turn 50 for the catch-up amount. But now they're letting you know 50 to 59 or 64 plus. So they're just giving you 60 to 63. All right, so 60, 61, 62, 63. They're letting you do that $11,250. All right, and see, I wonder how much this is being socialized by employers. I have not seen this information at all. It's something I'm gonna let my parents know about because this is just new this year. Let me see. I think my dad. No, my dad turned 64. Yeah, my dad's not gonna get. My mom will, because they're 2 years apart. So my mom would be 62 next year and 63. So she'll be able to do this as long as they're going to have this for 2026. I have to let her know about that it's going up because I don't know how much this is being socialized by employers. That hey, if you're between the ages of 60 and 63, you can actually contribute, $11,250. Maybe not even employers, just do the 401k providers. Like, hey, you fall in this age bracket, you can do $11,250 this year instead of $7,500. I mean, that's a lot of money. I think I always say if you want to know how much money you should be investing or how much like is a lot of money, the government's going to let you know based off what they limit from like a tax standpoint. And we're going to get into the IRA contribution limit here in a second for 2025, but it's around $7,000. So they're giving you almost $4,000 extra, $3,750 that you're going to be able to put in for these 4 years here: 60, 61, 62, and 63. Right, 63 is in between 63. All right, so that's 4 years of putting in almost over $10,000. That's a good chunk of money, especially if you're able to do a Roth contribution as well. You're not paying the taxes on it. That's a great change. I did not know that was coming. Okay, 401k contribution limits when you have multiple 401k plans with different employers. Oh, I lied. Maybe Fidelity's going to correct me here on the spot. I lied. You still limited the total employee contribution amount for the year. Don't listen to anything that I say. This is why I read these articles. Instance, you got two 401k plans. You may choose to put your contribution to $23,500. They're letting you know it doesn't impact your IRA limits. Yes, IRA limits and 401k limits are completely separate. Okay, complete correction here live on the episode. So if you do have two jobs, you still have to deal with the contribution limit across multiple jobs. So the limit flat out is $23,500 if you're under 50. If you're over 50 to 59, or if you're 64 and older, then the limit is going to be another $7,500 for the catch-up contribution. And then if you're between 60 and 63, you got a catch-up contribution of $11,250 on top of the $23,500 that we all get. All right. And still have the cap though of $70,000. By the way, it looks like here. I mean, let me make sure that doesn't change. Yeah, it's still $70,000 cap. Excuse me. And these are important to know because it does show up on your not only pay stub but your W-2 as well, your retirement contributions. After tax 401k contribution limits, if you reach the maximum that you can contribute to your 401k, you may be able to save more for retirement in your workplace plan through after-tax contributions. So not Roth quote-unquote contributions, but like after-tax, post-tax, however you want to look at it. That means that while your after-tax contributions have the potential to benefit from investment growth other than your 401k account, you only pay taxes on the growth when you withdraw funds in retirement. Okay, so what this is telling you is that this contribution is going to be treated like a traditional contribution or a pre-tax contribution when it's withdrawn. So for a traditional 401k, traditional IRA, when you withdraw that money, when you retire, let's say, that's when you pay the taxes on it. What it's telling you here for the after-tax contributions is you're getting double taxed, right? With the Roth 401k after post-tax, again, after-tax versus post-tax, a post-tax contribution for your Roth 401k or IRA, you will not pay taxes when you withdraw the money in retirement. But for this after-tax contribution, it's saying here you only pay taxes on the growth when you withdraw funds in the retirement, which is how it works for traditional 401k or IRA. You only pay tax on the growth when you withdraw the funds in retirement. But since this is after tax, you've already been taxed on this money. This is what you have after you've paid taxes. So you don't get any type of deduction benefit here. And then, if you want to put more money into it, you can. It just depends on what you want to do. Obviously, it depends on your employer plan. You may be eligible to contribute up to the total employee and employer contribution limit for the year. That's $70,000 for 2025, provided your existing employee and employer contributions do not exceed the limit. So you just gotta talk to your employer / your 401k provider to figure out exactly what you can do. Example here. So I love Fidelity. They just get so much good information. For example, if you're under 50 and contributing 23,500 and your employer contributing 20,000, 2025, you contribute an additional 26,500 as after-tax contributions to bring your total to $70,000. Look, if you're single and you got 26, almost 27 bands left to put into your 401k, look, and you maxing out your 401k, yeah. Anyways, shout out to you. Keep in mind that not all 401k plans allow these. If yours doesn't, or you simply want to save even more than after-tax contributions alone, then other strategies, again, you consider IRA, or you can even do a taxable brokerage account. Taxable brokerage account is not going to give you the retirement benefits because you're going to have to pay taxes on the growth year over year for any dividends you have in there, which you don't have to do for 401ks or IRAs. But again, they're just letting you know the two main retirement vehicles, 401k or an IRA. 403b, if you're a state employee. Oh, bad, y'all got my notifications going off. But they're just letting you know, what you have for 401k, 403b, right? Different type of things. What happens if you contribute too much to your 401k? So what happens if you listen? I got to make sure when I edit this, not to just cut off that part where I said, hey, you can put money in your 401k. Double money, even though you can't if you have two employers or more. If you put too much money in your 401k, if you defer more, your excess deferrals will be treated as income in the year. Woo, Cory's going to have y'all fumble the whole bag. Do not listen to me. Please listen to the whole episode, even when I clip them up. In that year that they made and tax a second time upon distribution. God damn. So it's going to crazy penalize you. Excess deferrals and earnings can be reported on Form 1099-R. R stands for okay, I'm not going to say 1099-R stands for we're going to recoup this money. Luckily, most 401k plans have infrastructure in place. Oh, okay, cool. Yeah, so if you switch jobs right through the year, how do you deal with this? Say you switch jobs, so you get a crazy pay increase, and you switch jobs and end up putting in too much. You may accidentally end up saving too much in your 401k. If this happens, you may request that any excess contributions be returned to you by April 15th, including any earnings it made while it was in your 401k to avoid the double taxation. So they're giving you by tax filing day of April 15th to sort of have some type of correction to that, so you don't have to deal with the double taxation. So there's a fail safe in here if you listen to me. How much you contributing to your 401k? That's not part of this episode. How to maximize your 401k contributions. Okay, shout out to Fidelity for that. All right, up next here, we're gonna get into a little bit more changes. Oop. I can't wait till I get a new mouse, y'all. All right, so we got here the highlights for the 2025 changes here. Again, this is where the IRA contribution changes are going to be, but the IRA is going to stay the same. All right, again, like I said, 403b, you got a TSP, 457 plans, whatever it is, whatever your thrift savings plan, if you work for the federal government, military, whatever your employer retirement thing is, it's going to be 23,500. The limit on annual contributions for IRA is going to stay the same. It's going to be $7,000. IRA limits don't get bumped up as much as 401ks do because they do it based off of inflation. And since they do $500 increases, it's hard to get justify the $7,000 increase, 7,500 with inflation being around like 2.5%. I believe they calculated it for this year roughly. Contribution limit, yep, it's still going to be $1,000 as well for IRA. So if you're over 50, they don't have this little threshold of 60 to 63 where you can put in more. And then if they make it so if you're 60, 63 and you can put in a little bit extra in your IRA as well, that is a sign of how much money you need to retire. All right, but again, that's why I said here, like, if you want to know how much money you need to be putting in, they're letting you know that $7,000, right? It's like, you got to put in at least $7,000, right? But they're telling you, give me a total between your IRA and your 401k of $30,500. Then we do the total amount because of the $70,000 for your employer-based plan, giving you almost $80,000 a year. They're talking about investing, all right, into your retirement. Cultural contribution limit that generally applies for employees age 50 and over to participate in these various retirement plans remains 7,500. Okay, we already went over that. They're talking about income ranges for deductible contributions. All right, it's giving you phase out ranges. Nah, I don't get too crazy into retirement type stuff here. All right. Again, that was here again. So I didn't cover the IRAs that much. Let's just watch the episode last year, but it's $7,000 for this year. All right. As we get in here to wrap up here, the last one, HSA contribution limits and eligibility for 2024, 2025. In 2025, you can contribute $4,300 if you're covered by a high deductible health plan. Again, got to be under a plan that is a high deductible health plan, or at least qualifies. It doesn't always have to be a high deductible health plan. That's usually just the name that you'll see, so you know that it usually qualifies for it. But they're like, it has to be a certain deductible and things like that that actually qualifies the plan. Like if you're looking at a marketplace health plan, then if you got a family plan, and again here you're going to be at $8,550. So these numbers here, and it's so funny. This where it says if you're covered on a single plan or not a family plan, that's nothing to do with your tax filing status, right? It's just whether you're on a family plan or not. So if you just, married, right, no kids yet, then you have both of you on your insurance plan, then you qualify for the family plan. If you're married, but let's say you have health insurance at your provider and your spouse has it at theirs, but you have, just the single one at your provider, you're still at $4,300. All right. So this has nothing to do with your tax filing status. It's just the actual plan that you select via your employer. If you're over 55 and over, you can do $1,000. Also, again, as well, not all the time, but a lot of times with these HSA contributions, again, like I said, if you do them through your employer, you're not paying any taxes at all. If you do post-tax contributions and then you claim the deductions when you file, still going to do with Social Security, that FICA tax you need to pay. But you are a lot of times able to invest this money. Sometimes when it's through your employer, you got to keep like $1,000 in the account. But once you're over that $1,000, especially if your employer does an HSA contribution, which a lot of employers are starting to do now, not only do they do the 401k contribution, they're also doing an HSA contribution. It's just like a flat amount. It's not a percentage, it's like $500 or something. But once you're over that amount, this is how it was at my last employer, I was able to invest everything over $1,000. And it was essentially set up like an IRA, which an HSA essentially turns into once you hit that 65, I believe, age. It's essentially a traditional IRA. And again, for an HSA, you're not paying any taxes on any qualifying medical expenses when you use this money for that. So just think, you can invest this money once it's over $1,000, and it's like an IRA. When I'm saying that, meaning you can invest in single stocks if you want to. Not saying to do that, not investment advice, but just the flexibility that this account provides, or really the options more so than flexibility. You can invest that money into the stock market, and then you can take that money out for medical expenses and pay no taxes. And again, while it's invested in the stock market, you're not paying any taxes on the growth at all, like your IRA with dividends. So if you pick something that is a dividend, paying stock or an ETF, mutual fund, whatever it is, something that pays dividends, you're not paying any taxes on it while it's growing in there. And then you can take that money out and use it for a qualified medical expense and pay no taxes at all. And remember, I said you also get the benefit of the tax deduction for your contributions. Okay. So you got tax benefit on your contributions. You got the tax benefit as far as it growing tax-free. Then you got the third tax benefit of being able to use the money for qualified medical expenses, not paying any taxes on what you withdraw for the qualified medical expense. All right. So again, the long story short, if anyone ever says, what's the best like investment account or anything like that, like the best account you can have, is going to be an HSA. And I believe still for 2025, HSA and FSA, the qualified medical expenses are the exact same. And then also as well, sorry, y'all, I'm trying to make sure the bottle is not in the camera. Main difference between HSA and FSA is the HSA money rolls over. FSA money you had to use by a particular period in time, or it all just vanishes. So HSA, long story short, is traditionally viewed as better than FSA. Whatever you need for your family healthcare needs, what your employer provides, because the FSA plan might be better for from an insurance standpoint, even over the HSA plan. It all depends. Everyone's medical situation is different, so obviously do what is best for you. But again, if you're able to make use of the HSA, highly, highly recommend you do it. If you're worried about, Cory, when should I put the money, when should I invest into it? A lot of times, I say invest, when should you make HSA contributions as far as like over what you need for your medical expenses? Obviously, whatever you need for your medical expenses, put that in. But, usually I believe your employer, traditionally what I've seen is they give the contribution, let's say $500, regardless if you're putting in money or not. But then, whatever you need in there, you put that in. But if you want to put some more money in there so you can start investing it, then, that you can start doing that around when you're trying to, really put money into your retirement, that 15 sort of percent amount for the people who follow baby steps. That baby step 4 range is really when I would say, like, when you should load it up. But it's not that big of a deal. Load it up's a bad word, but when you should look to invest into it. But again, like I said, your employer usually going to have a set amount of money. Like I said, my last employer was $1,000. So once I was over $1,000 in the account, everything over that just went and got invested. I was able to set it up that way. So even my employer contribution that was getting invested and how much money I was putting in was getting invested. I was still putting in, how much money I needed. I didn't need anything because, knock on wood, but I'm relatively healthy. I'm not relatively. I'm a healthy person. I'm a perfect attendance kid. So I rarely get sick, things like that. Thankful for that. So this was just, icing gravy, however you want to look at it for me. All right. Again, we already went over those limits. Again, HSA eligibility, they're just letting you know you need to have a healthcare plan that qualifies for it. What they're letting you know here is it has to have an annual deductible of $16,000 for self-only coverage. Sorry, that's 2024. But long story short, let's just say it's not, you don't see the words like high deductible healthcare plan or ADHP, which is the acronym for it. But what they're letting you know, this is for 2024. But long story short, if it just says something like, if you have an annual deductible of $1,600 for single or $3,200 for family, and the out-of-pocket maximum, including an annual deductible, does not exceed $8,050 or $16,100 for family coverage, $8,000 for self coverage, then that healthcare plan qualifies for that. So even if it's not a high deductible healthcare plan, if it has those annual deductible and out-of-pocket maximum limits, then it will usually qualify for you to be able to put money into an HSA. And again, this is one, if you're paying attention to all your tax forms, you get all these various tax forms at the end of the year about your healthcare and things like that. They're going to ask you, did you contribute to HSA? If you're filing your taxes yourself and all these various type of things to see if you're meeting all these rules / the laws, not really the rules, all these laws that they have in place for this type of stuff. Then it's letting you know to contribute to an HSA plan, you can't be enrolled in a health plan that is not an HSA based, nor can you have a full purpose health care flexible. So FSA, you can't have it. Yeah, you can't have FSA and HSA. You can't be enrolled in Medicare and you can't be claimed as a dependent. So if you're working, but you're still making use of Obamacare, you're 22, 23, 24, and you're being claimed as a dependent on someone but have your own health plan, you can't contribute. And again, the crazy thing too is the deadline for HSAs from a tax standpoint is April 15th. Isn't that crazy? They give you a whole extra 3.5 months to put money into it. Insane. There's letting you know that if you're not enrolled in the HSA healthcare plan for the whole year, that it's prorated. Again, also as well, you'll see this on the tax form that all the boxes that are checked, when you had healthcare coverage. Penalties, HSA versus FSA. We'll go over that real quick. HSA versus healthcare FSA. Healthcare flexible spending accounts, or FSAs, are another common way people use tax advantage dollars to save for qualified medical expenses. While it may seem like double dipping, you can actually contribute to an HSA and healthcare FSA, provided your FSA is HSA compatible. Again, depending on if your job even offers this. This means that it's a limited purpose FSA that can only be used to pay for certain qualified expenses like vision or dental. When used together, an HSA and limited purpose FSA can help you save for qualified medical expenses each year. In 2024, typically, you could contribute $3,200 to a limited purpose FSA or $6,400 if both you and your spouse have access to an FSA through your respective employers, on top of what you contribute to your HSA. Keep in mind, though, that healthcare FSA funds are typically subject to use it or lose it rule, like I mentioned earlier. You must use all contributions within a year or forfeit whatever is left over, with some exceptions. HSAs, meanwhile, do not have this rule, allowing you to save and invest contributions year over year, like I said. All right. So I just want to go over that because I made a big blunder about the 401k contribution. All right. All right, y'all. And as we're beginning to wrap up the episode, we're on an hour bender. Anyways, last year it was like 45 minutes. Tax withholding calculator. Again, this is for the tax withholding. estimates for those that decide to stay to the end of the episode. You stayed here for a whole hour. Put in the tax withholding calculator. Long story short, you come in here, put in your information. This is going to give you a guesstimate. Again, it's the IRS website. It's going to give you a rough guesstimate of what it thinks you are going to owe for taxes, or if you're going to get a refund. And then you can use that in conjunction with the AWS. That lets you know what's on my mind. In conjunction with the ADP paycheck calculator. So the ADP paycheck calculator, you come in here, you put in your paycheck, how much you make, your pay frequency, your tax filing situation, your state where you live at. It'll also, if you're someone like me who lives in Maryland but works in Virginia, it'll allow you. So this is actually the state that you work in. So for me, it's like I work in technically Virginia, but then it's asking me, do I live in another state? Right, so I got to put in where actually my actual address, and then it's going to calculate all these things for me here. And then you're going to put in your benefits as well, how much you pay for medical, dental, vision, if you're doing, FSA or HSA contribution, and then your type of retirement amount, and then it's going to shoot you out in short here, what it believes your take-home pay should be, and they've updated this now over the last year or two to where it's going to be relatively the same. It's $1,000 per year. Let's do. All right. So this is just, if you're single filing, tax status, no kids, nothing like that, it'll shoot this out. But I'm saying you can do this in conjunction here with this paycheck calculator. And if it's saying, hey, you might need to withhold, so send more money to the government, another $100 per paycheck, you'll be able to update that here as far as, I need to send another extra $100 here because they're going to ask you here. Sorry, it's going to be on the federal one. For your federal taxes, they're going to ask you here any additional withholding. So if you do this IRS paycheck calculator, it's saying, hey, you need to withhold another $100. You can see that here and really see how it impacts your paycheck and see if you really wanted to do that, if you can afford that, as far as on a month-to-month basis, wherever you're at financially with your budget and things like that, or if it's better off for you to figure out some ways to save that money throughout the year. So when you actually file your taxes, you have whatever money they're telling you you're going to owe. All right. So those are all, wait, my bad, y'all. I'm showing it on screen. Here on the federal tax tab, and you scroll down, you'll see additional withholding here. You put like $100, right? So you'll be able to see that. All right. That's it, y'all. Locked and loaded. End of the episode. See, we're starting off 2025 well. Again, as we're getting into 2025, the major updates. So I told y'all I had a lot of things going on like September, October. That's because my wife is pregnant again, baby girl on the way, due Memorial Day. So as we get to late April, early May, some things, I'm going to try to have episodes and things like that recorded, but we'll see. But, we're going to have that transition phase and we're going to be good to go. My wife had a very, very rough first trimester. So, it was just hard. And she was harder on her than me, right? But, since we already have a kid, it's hard dealing with, not hard dealing with our son, but, just managing everything. Shout out to our village that helped us out during that time. But then also as well, our lease ends at our current apartment at the end of February. And so we will be moving back in with my parents because we're getting a house. Our house is being built right now. It'll be done sometime. I want it to be done in early May, but it'll be done in like mid to late April, early May time frame. So I'll be back in with my parents since our lease is in a couple months, where the house is built for a couple of months. And then after that, I'll be moving again. So if you've been watching this, since we started this would be like my fifth time you've been seeing me move. Right? It's been crazy. We had to move back into my parents for a couple of days, like a week or so, when we had that plumbing issue at our very first apartment. But this will be you can see me move 2 times. You see me move the second time when we get to June, okay, because the house will be built in June. We'll be in that joker in June. I'll be on paternity leave then. Then you will be seeing just a blank white wall, technically, because we're not going to be set up. Right, my office is probably going to be one of the last things that finally get settled. But got a lot of stuff going on in 2025, so we got major updates. So moving 2 times, having a baby, gonna be a lot going on, but also highly unlikely that I'll be recording like this during that time frame. So what I'm likely gonna end up when I'm at my parents. So what I'm likely gonna end up doing is going to do car recordings, which might be something that'd be more permanent because I go into the office twice a week and I'm driving to Virginia. So it's over an hour drive from me there and back. So plenty of time to record something. We'll switch it up and give, a different flavor on here. And also as well, going into next year, we're going to ramp up the type of content that we are recording. So we've been doing more financial stuff, and we still know health and wealth, finance, fitness, everything in between. We're going to get a lot more into the in between stuff, and we're going to start doing articles that are not just more on the political side, but just flat out news in general to sort of give you guys an update of everything that is going on. So I'm not going to say what the next episode is going to be for Money Mindset, right? But it's going to be a little bit more on like paying attention to what is truly going on in the state that you live in or the country you live in, or obviously, country you live in, United States, but even what's going on a global standpoint. So when I start having even more and more articles to sort of keep up with the information that's going out, into the news cycle. And obviously, as like my schedule changes with the baby coming, things like that, I'm going to try to make sure the articles are as up to date as possible because I want to get the information out to you guys faster, so that one is better for the algorithm and the information is still relevant. Like I did the United Healthcare unfortunate shooting, and that when those rest of those videos were dropping, the shorter clips, a new article had already come out that kind of made all that information irrelevant that I was talking about. So gonna work on improving that process as well. This year was big, like with the consistency on editing the videos and the thumbnails and things like that. So we're showing the progression here. And yes, where's Jordan? My schedule was messed up due to not like due to my wife being pregnant, but once she was pregnant, how bad the first trimester was, and so I got to sync back with Jordan and get on a better schedule. But that's kind of pointless because then I'm being my parents stop recording. So Jordan may not resurface, unfortunately, until like May or June with myself. Jordan can record whenever he wants, but let's be very clear. So I'm gonna take a shot, but Jordan has access to the StreamYard and all that type of crap too. Technically, I think all the emails are Jordan's accounts. Technically, I think that we set it up. So, or at least his name is it. So Jordan can record when he wants, but that's everything that'll be going on 2025. Again, baby coming, Memorial Day, new house coming, late April, early May, but then I'll be moving back in with my parents from like mid to late February until whenever the house is built. So we'll be having all the transition. And then if these recordings do end up going away, then I'll be doing the car recordings. All right. All right, y'all. That's it. I'm saying all right, like you guys can hear me like I'm talking to one of my clients. All right, y'all. That's it. Locked and loaded. End of the episode. Make sure you comment, like, share, and subscribe. Shout out to the YouTube algorithms. Make sure you leave those rating reviews on the podcast platform as well. Let us know what you thought of this episode. Please, if you have any suggestions, let us know because we're always about revamping and giving you all the information that you want to see in conjunction with what we want to do because this is our YouTube channel, our podcast. All right. That's it, y'all. Remember to save more and say less. Keep making better your best. And I'll catch y'all in the next one.